My name is Ronnie Shalev. I'm the co-founder of Shalwin Properties. I'm an emergency room doctor that was able to financially retire after investing passively in apartment syndications. Now, my mission is to share this knowledge with anyone who's feeling stuck and wants a way to create more space, more freedom, more flexibility, so that they can live a life that they want. The biggest thing I hear from investors is that they don't understand how syndications work. Well, syndications are business structures. They're business structures where investors pool their money together to buy large commercial properties with a bank loan. This presentation is going to explain how the deal works throughout the life cycle of the investment. Whenever you're buying a commercial asset, you're buying a business. Not only is it a tangible building and has associated land with it, but it's also a real estate business that generates income and has expenses. There are different strategies when buying commercial real estate. You can buy and hold. You buy at a certain price, you hold it indefinitely, and you live off of the cash flow it provides. You can ultimately sell it at a higher price, or even leave it as inheritance to family. With syndications, the short answer is, as with any real estate business, we buy the property and sell it at a profit. Since these deals typically have 100 investors or more, they're not held for generations. They're held more like 3 to 7 years. The other strategy that's typically used is called a value add strategy. That's where we acquire the real estate, increase the income and revenue stream, which increases its equity and its value, and then ultimately sell it. That's called a value add strategy. So how do you create value? Well, you can increase the rents, you can increase your other income, or you can lower your expenses. So how do you increase rents? Well, there's two ways. There's something called organic rent growth. That's when you're sitting and doing nothing with the property, but the market is driving rents to go up. And that could be from high demand, people moving to the area, things like that that drive market growth. And that's organic rent growth. And that could be between 2% to 4%. But in some really hot markets, we've been seeing up to 14%. Austin, Texas has 14% rent growth. Las Vegas has 14% rent growth. Houston has 9% rent growth. So the rents are growing even though you're doing nothing. That's called organic rent growth. The other way to increase rents is by forced rent growth or forced appreciation. That's when you go in and you do something to the property. You might renovate the kitchens. You might put in quartz countertop or granite countertops, put in nice flat backsplashes. And then you offer the residents, you can have a renovated unit, but the rent is going to be higher than a classic unit, and charge a higher premium for that. That's how you can increase rents. Other ways to increase income of the property is by offering different services. You can offer carports, covered parking, private yards, offer the ability to have a pet where you charge not only a pet deposit, but you might charge pet rent monthly. These all increase the income stream to the property, therefore adding value and increasing the value of the property. Third way is really lowering the expenses. And that's with any business. You always want to optimize your expenses and making sure you're getting the best rate for everything. So if the owner is responsible for utilities, the electric bundle, you can always negotiate. If you're in charge of the electric bill and the tenants are not paying it, but the owner is paying for it, you can install LED lighting. That'll lower the electric bill. You can install high energy efficient windows. That'll lower the electric bill. You can put in special thermometers. That'll control the electric bill. If you're in charge of the water, you can put a water conservation plan together where you install low flow toilets, and lowering that water bill will actually increase the value of the property by lowering the expenses. So there's a lot of different ways to increase the value of a property. Like we said before, really the time frame is 3 to 7 years. Shalwin Properties tries to restrict it to more like 3 to 5 years, but things do happen, and it might be 7 years, but typically we look for 3 to 5 year deals. And what's the exit strategy? Well, the exit strategy is you either buy it and sell it, you might buy it, refinance it, return the money to the investors, and hold it for another 2 years, 3 years. And money that's in there in the investments, your cash on cash is actually infinite because you've pulled out your investment. Now you're just getting cash flow with no money into the deal. Then ultimately you can buy it, refinance it, and then you can sell it. So what are the different splits? Well, you've heard the term limited partner, general partner. The general partner or the sponsor, they're the ones that are finding the deal. They're the ones that making sure that the numbers pencil. They're the ones that make sure that they get the loan, make sure that they're doing the due diligence. They're the ones that are creating the business plan, the exit strategy. They're the ones that find the investors. They're the ones that do the investor relations. They are the ones that execute the business plan, and they're the ones that ultimately sell the property. They're in charge of the whole thing, soup to nuts. And they are typically the ones that put a lot of the money and time up front for the deals. The limited partners are passive. They're not making any major decisions, but they are putting in their money and collecting the income that's coming from the property. So the LP-GP splits are really different in every single deal. Some deals where it's 80-20, there's some deals where it's 70-30. There's some deals where it's 90-10, and then after a certain amount of revenue, or if the investors get their money back, then it splits to 50-50. So really every single deal is completely different, and there's different structures. So just be aware that there isn't one way and only one way to do it. What are the different fees? Well, there's acquisition fees. These are very typical, between 1% and 3%. And why are there acquisition fees? Well, the sponsors are the ones that are finding the deal, spending weeks, if not months, prior to the passive investors even seeing the deal. And oftentimes they're putting non-refundable money down, between $500,000 to even $1 million that's non-refundable day one. So there's a lot of risk associated with it, and the acquisition fees typically cover a lot of that risk. There are also property management fees. The property management company, they're the ones that actually manage the day-to-day asset. So they're the ones that are collecting the rents, they're leasing the apartments, they're dealing with tenant complaints, they're evicting the tenants. They take 3 to 4%, and that usually comes from the on the expense side from the profit and loss, from the income of the property. And then there's the asset management fee. That's the general partners take in asset management. They're the ones that are overseeing the property management and making sure that everything is going according to the business plan. Typically, it's 2 to 3% that is typical to see. And then there's a disposition fee. Sometimes people don't take that, and some teams do take it, and that's if there's a refinance or if there's a sale. A lot of times there's a lot of paperwork that has to happen, so the sponsors might want a disposition fee associated with it. So that's it in a nutshell of how the deal works. If you found value in this video and you're interested in growing your wealth through apartment investing, go ahead and click on the link and schedule your call with me today. Also, be sure to follow us on Facebook and on Instagram.